All right, I want to ask Victoria Greene to start making her way up here, but she's already beat me to it. I had to fight to introduce her because one of the best member blenders, it was a construction consortium. Where was it? Beerfoot? I don't remember it, but it was a relaxed atmosphere, and we're going to leave it at that. She was awesome. I think the only thing better than Victoria at an event like this is one that is a little more intimate, and Beerfoot meets that category. But welcome again. It's a treat as always. Victoria Greene.
And as a very good Aggie, I'm going to start this off with a solid howdy. There we go. And I apologize. I am probably going to run out of time. I got a little excited about this. I was like, oh, this is a neat slide. Well, I want to show this. And if I do run out of time, which is a very high possibility that's going to happen, that gentleman in the back, everybody knows Jason Hardcastle. He's going to have these slides. He's welcome. He can get them to you. He knows my thoughts. We talk all the time about markets. So if I do run out, he's going to be the guy that's going to be able to help you all out. So, obviously, not a lot going on in the world. Super boring time to be alive. Everything is just status quo and easy peasy, right? Absolutely not. World feels terrible. Dumpster fire. It is very hard to stay focused right now because right now the world feels like we're just going the wrong direction. We have all of these headwinds. How can the market be rallying when you have everything that feels like it's going wrong in the world? And all you have to realize is the market is about what's going to happen. Is the world getting better or the world getting worse? The market, it does not necessarily care where we are today. It cares if we are improving or deteriorating. And our base case thesis right now is the world is getting better. Earnings are growing. We're seeing massive efficiencies happen with technology. You cannot underestimate what's happening with AI. AI is Internet 2.0. It is not a bubble. So that's why we're bullish. First off, we got four, I call them tent poles or, legs of my stool. But we have 4 reasons we're bullish. Number 1 is historical precedent. When we get to this point in the year and we rallied, 90% of the time, we're going to continue to rally in Q4. Just historical precedents. Secondly, we're hitting the strongest period of the year. This is where you want to stay invested. The Santa Claus rally is a real thing. We typically get very strong performance, and it's been even stronger the last 10 years. But since 1929, Q4 averages almost 3%. Thirdly, and it is a big week this week. We have Apple, Amazon, Meta, Microsoft, Google, most of them reporting this afternoon, if not tomorrow afternoon. They are growing earnings, and they are growing earnings rapidly. These companies make tens of billions of dollars in profits, and their profits continue to grow. And they were making money long before AI happened, and they will continue to make money, and it's going to make more money because of what's happening with technological efficiencies. And then if you look and you step back and you say, well, what do the charts say? What do the tea leaves say? They all point bullish. I know it's scary. We hit all these new all-time highs. We have all of this out there with tariffs or trade wars or government shutdowns, and the consumer feels tapped out, and inflation's really been a stressor, and everybody feels that. Grocery stores now, $150 used to be $100 5 years ago. Your basket of goods definitely costs more. But I would not ever bet against the U.S. consumer. I think the thesis that the U.S. consumer is broken and going to stop spending money is inherently false. The consumer is trading down a little bit. The consumer is looking for value in their life. Maybe they're going to Walmart. Like Brinker just reported this morning, Brinker owns Chili's. Chili's is having a revitalization. Their same-store sales are up 21% year over year. Their foot traffic is up 13%. People are still eating out. They're just being a little bit more judicious in your choices. And as business owners or anybody selling anything right now, you need to show value. You need to say, what is the consumer getting when they're coming to visit you? And it's the Chipotles of the world that are struggling because nobody wants to spend $20 on a burrito. But the Taco Bells in the world and McDonald's are still doing very, very well. So when you look around the world, you realize the consumer is still going on vacation. They're getting on those cruise ships. They're going out to eat, just a little bit more judicious in their choice. So where are we in the markets with all that background? Doing just fine and dandy. Some of the markets are up more than others, and it's the technology-driven markets. Not everything is equal. This is not a rising tide lifting all boats. You have some stocks that are lagging. You've got some good quality companies that aren't performing as strong. You look at the Dow Jones or the Russell 1000 value, kind of the quality dividend stocks, they're up about 10% on the year. You've got NASDAQ, tech stocks, growth stocks, emerging markets, China, they're up to 25 to 30% on the year. We anticipate this rally is going to continue. And one of these reasons, we talked about the seasonality, and I apologize if this is a little small, but darker the green, the better it is. So you can see that far right column, that's Q4, the last 10 years, how the market, the S&P 500, has performed in Q4. We've had one down year, and it averages 5.31%, and we are on track to hit that this year. And we are about to hit the strongest part of Q4. October sometimes has a little shenanigans. October often is known as a spooky month, not just Halloween, but a lot of bad stuff tends to happen randomly in October, like market crashes, Black Monday, like it just has a bad namesake. But once we've gotten through that, it is smooth sailing. We're about to hit very strong periods. We're getting the earnings growth. The consumer's going to spend. People are going to start going out, buying things for holidays. It's there. And if you look at the charts and the graphs, you want to stay invested during this period. And so the other thing I always point out is markets rhyme, right? It's never different. Those are probably the 4 most dangerous words in finance. This time it's different. Never different. Promise you that. So what I did is I put together a time lapse, and the red line is in 2018, the last time we had a bad Q4, we had a little bit of a meltdown, and the blue line is what's happened to the markets right before Liberation Day. And then, so you look at this and you can tell they are very highly correlated. This time series overlay, 2018 meltdown, Liberation Day meltdown. And then if you look and you say, well, what happened next? After this happened in the end of 2018, in 2019, 2020, and 2021, which a little bit again of a small little drawdown around COVID, but we bounced back around that real fast. Averaged 26%. So when you look at this, markets do go down. It does happen. But the likelihood that we're going to have a continued expansion, in my opinion, is extremely strong because you not only have fundamental earning growth, you have some really good charts and technicals backing you up. And so when we look at that and say, what is driving this? Why are we so excited still? Like, everything's expensive, stocks aren't cheap. You're right. You're not going to bargain hunt in the market right now. It's not buy one, get one free. Things are fairly well valued, if not a little expensive. Average PEs are a little bit above average now. Like nothing is cheap, right? There's no discounts. But this tends to be a momentum-driven rally, and it tends to be because what's happening in technology. And probably the biggest debate on Wall Street right now is AI a bubble? Is this just a bubble? Is this what happened, in the 1990s, 2000s tech bubble? Is this all just make-believe, or is everybody just promising, NVIDIA promised to buy 10 billion here, and then OpenAI is promising 10 billion in NVIDIA, and then AMD is promising 10 million to OpenAI. We call it the concern of circular spending. Everybody's kind of passing the same 10 billion around of, absolutely, I'm going to invest 10 billion in you, and you invest 10 billion in me, and we all basically invest the same $10 billion, except it's actual real money. We are making real things. This isn't pets.com. That's my favorite reference point. There was a point during the internet bubble that people were buying domains that had no revenue, 0 earnings, nothing other than wing and a prayer and a hope that this website is going to be the next big best thing. Pets.com was one of them, and they got bid up to like $10, $20 billion in value. No revenue, absolutely nothing behind it. Didn't even sell pets or pet supplies. It was just a domain name. When you look at companies like that, they deserved to go bust. They deserved it. They were valued. It was crazy. It was frenzy, and they had zero earnings. That is not what is happening here. Pre-AI, Microsoft was still printing about 10 billion in free cash flow every single quarter. If you look and go back and you say 2-3 years ago, before we get in this kind of frenzy about AI, Amazon, massively profitable. NVIDIA, making chips. And I don't know about you guys, but I now actually proudly own, not proudly maybe, a smart toaster. Wasn't sure I needed a smart toaster. Got sold it, looked pretty cool. Not that smart in my opinion, too many buttons, kind of want to go back to analog. But I'm bringing this up as a reference that chips are in everything. Your refrigerator's smarter than you now. God forbid your car knows everything about where you want to go, and please don't, hit that curb anymore because your car's getting smarter. Everything in your household, in your vehicle, in your office is going to need a chip in it. The number of chips in your phone is just exploding. NVIDIA makes chips. They are making things that are being used. They're innovating things that are being used. The number of circuits now on a chip is just mind-blowing, how fast technology is moving. So for me, I look at this and I say, is this a bubble? No, because we are using products that are going to continue to be more and more integrated into our lifestyle because we're not moving the other direction unless we have like a massive solar flare like horrible event. You know, if you want to find like meteor or Yellowstone caldera finally erupts, like you can find a reason we'll go back to the Stone Age. Probably not going to happen. We are probably going to have even more chips in our life in the next few years. And I know we started a little bit late, so do you want me to stick to our time frame or keep going? All right. I like that. The other one I hear about is this has happened too fast. It happened too fast, too quickly. This is a normal bull market, very normal. We are up about 98% in 36 months. But if you look at it, we're lagging other bull markets. Historically, it says a bull market lasts about 5 to 6 years, should go up about 150 to 250%. That is a normal bull market. And we had a bear market. We had a nice, ugly bear market in 2022. We sold off, everything got cheap, people panicked, end of the world's coming, bounced in October 2022. Since then, we've had a nice little rally. We did have our little Liberation Day kerfluffle there, but we gained that back within 3 months. But we're not above historical norms for a bull market. This is just what happens. Stocks rally, everybody gets excited, and we think we have a few more legs to go. And one of those legs, my other part of the stool, is it's not just about price, it's not just about pretty charts, it's about the fundamentals of earnings growth. When you look at it and say, how much are we growing? They're growing on average 9.2% this quarter. Earnings are growing 9.2%. 85% of companies that have reported have beat their earnings expectations. And that is crucial because it's not just about did you make profit. We now expect massive profit, and quite frankly, we expect profit growth. It's are we growing profits faster? Are we growing revenues and sales faster than anticipated? Are your margins, which is crucial, are your margins staying where they need to be? Or are you growing your margins, or are your profit margins slipping because the cost of labor or cost of goods is going up? Profit margins are actually still expanding. Earnings are still expanding at above average pace, and we're seeing great earnings from overseas, because even if you're investing in, say, a Microsoft or a Meta or a Google, their international earnings are actually a lot higher than you might anticipate. It's about 50% for Microsoft, because we're not the only people that use Office or use their things. It's a global company. So even though they're headquartered in the United States and they report in US dollars, most of these companies have a significant amount of revenue exposure overseas. We often joke that Budweiser is more of an emerging market stock because they sell more beer overseas than they do in the United States. And so as you're looking at the S&P 500 or you're looking at some of these big multinational companies, they're getting a good pickup, and they're growing faster overseas actually than they are growing in the United States. And we're also getting help from a weaker US dollar, which is actually very helpful. Stinks if you're traveling abroad. I know Europe was super cheap there for a while because the dollar was so strong. But a strong dollar is actually a big headwind to a lot of these companies, because if you were going to make 100 million profit in Europe and the dollar was so strong, by the time you translate it back, it's not worth quite as much. So we look at this and say, US profits are growing about 9%. International portions of those profits are growing almost 12%, and we do not see that decelerating. We are seeing this trend accelerate, and we have, I'm not going to say never, it is very, very rare you would ever have a bear market when profit margins are expanding and when earnings are growing. So you look at that, and you look at the legs that are still here, and you should get excited about it. And if you look at time, it's not just the price. The light blue line is the S&P 500. The dark blue line is the earnings per share, like how much are these generating. They are being supported. Yes, it's expensive. Nothing's cheap. Your multiples are a little bit high. But you're also seeing consistent earnings growth that is supported by fundamental growth from companies. And then, because I always talk about what could go wrong, and I know I'm all of the, well, yes, but this, or how about that risk, is AI a bubble? The other one I get a lot is, trade and tariffs, which have been a thorn in our side. And this is obviously evolving, and likely gets completely settled this week. The trade deal's getting done. That's our base case. Deals are getting done. Things are not as expensive. The actual aggregate tariff rate right now is 10%. There's a lot of headline things, 50% here, 100% there. We hate Canada, we're going to throw another 10% on them. But what you don't see is there's a big asterisk on that, is that every good covered by UMESCA, which is the old NAFTA, is exempt. So about 85% of trade with Canada and Mexico isn't being hit by these big tariffs because they're exempted under other trade agreements. Or you have a lot of other backdoor things being built in. If we have steel tariffs, but these things will be exempted. So the actual aggregate, even though the headlines look big at 25, 50%, tariffs have been much, much lower. Caterpillar reported this morning. They did a great job, and they stock's up about 10% last time I checked, and they said, yeah, our tariff hit's going to be about 1.8 billion. Like, people are now, this is what it is, we can plan for it, we can move on from it, but we're seeing industrial expansion. China's obviously huge. Soybeans would be great. Export rare earths. Everybody now is talking about rare earths and magnets, and hopefully that gets done. It's going to take us a really long time to build up a domestic supply of anything. Like, to build a copper mine takes a decade. To actually go mine and refine and build these products, even if we start doing things and we start investing in companies and we work on domestic supply, it takes a very, very long time to move that from here's the idea, here's the business plan, here's the investment, to we're actually producing what we need for our technology. So China is crucial. It's not just cheap toys for Christmas. China provides a lot of things we need for industrial work because of their stranglehold on rare earths. Shutdown. Let's talk about the shutdown. So there's a new thing out there called the prediction markets. Kalshi and Poly Market are the two biggest ones. And basically, people can gamble or bet on events, and they have been extremely accurate. Right now, the market is betting government shutdown doesn't end until November 13th, about 44 days, making it the longest government shutdown. And it's brutal. People are missing paychecks, air traffic control. Your flights might start getting a little more delayed because they may have to back off the number of flights they can support. It is a GDP drag, an economic drag, and a huge financial hardship for those that are impacted. And we are not trying to make light of that. It's ridiculous. And I feel for anybody who is working without a paycheck, because I'm not going to lie, if I'm showing up to work for a month and a half and I'm not getting paid, I'm not going to be happy about that either. But that's where we think it's going to end. It's going to be long. It's going to be ugly. They're not even negotiating while Trump's over in Asia. So we look at this, and it is a drag, likely going to get solved, and that's why the markets aren't concerned about it, because the markets say, yeah, this is miserable. We're really sorry for everybody affected, but end of the day, we're not worried because it will get resolved. That is what's going to happen. They will find a compromise somewhere. We will reopen the government. Everybody's going to get their paycheck back. Just miserable for those affected. And right now, that's our best guess is November 13th. But the markets also are saying this will get resolved. The other reason we're bullish, the Fed, accommodative Fed, they are meeting today at 1 p.m. They are going to cut rates another 25 basis points. We are very bullish that they're going to cut rates again in December, and then they're going to continue to cut rates next year, partially because the Fed board composition is changing, but it's also they need to ease because the labor market is starting to turn. And labor is something you need to watch carefully because you have everybody from UPS laying off to Amazon laying off 30,000 workers because all of a sudden we don't quite need as much office staff or we don't need quite as much industrial staff. Between robotics and AI, the amount Amazon can move around a warehouse with much less human capital is going to continue to increase tenfold. So I have some more cool slides. I'm going to end with one that I'm going to call a fun slide. But, here's gold. Sorry. Yes, gold's super expensive, but when you put it in a ratio of gold versus S&P 500, it's not quite as expensive. Everything's relative in finance. Nothing is absolute. Gold's expensive, a little bit toppy here. Markets can go down. Always want to remind people of that. Yes, we're bullish, but markets can go down. Do you know this year, we have not gone down more than 3% total? Not 3% in a day. The market has not dropped since Liberation Day, not dropped more than 3% total in this uptrend. It is a very strong uptrend, and what happens here is new highs beget new highs, momentum kicks in, people start getting FOMO, people that have been waiting for these drops suddenly say, well, it may not happen, I got to get in there. But on average, markets do go down. Yes, yes. Very important things here. My fun slide, Halloween. So, everybody, it's spooky season. Halloween's on Friday. Y'all are big Halloween people down here. Obviously, chocolate is expensive, but our spending is expected to be robust, not just because chocolate and candy are expensive. One, we are seeing people opt out of chocolate. So the bar graph is showing you the red is non-chocolate, and the orange is chocolate. And people are trading down to, Skittles and Twizzlers or gum or whatever we're doing because chocolate is definitely expensive. But we're expecting $1.8 billion spent on Halloween alone. And of that, Hershey's and Mars gets about 80% of the chocolate spend. And so as you're thinking about this, go support, because Hershey's publicly traded, so we want to support our U.S. companies here. But just realize we're gonna have a massive Halloween spend, and all of this is great for consumers. Spending on Halloween costumes, spending on candy, and so I just thought I'd be remiss to not have a fun slide in here about candy. So expensive, yes. but we're still going to buy it. And that's the thesis. Everything's expensive right now. It's very hard to find something that you don't feel is not expensive. But people are still spending money. They're buying that plane ticket. They're going out to dinner. They're buying Halloween costumes. And quite frankly, they're looking like a great and robust retail season for Christmas. Everybody's still going to buy. Everybody's going to decorate. Everybody's going to spend money on Thanksgiving. And just because things are expensive doesn't mean it can't go up more. And it is a very bad bet betting against the U.S. consumer. And we also have good data from banks, credit card companies. Amex has reported, Visa, MasterCard. They're all saying our net charge-offs are fine. We have growing balances, yes, but our delinquencies and charge-offs are fine. You even trade down and you say lower consumers, so like Capital One and Ally Financial, both of which cater to lower income consumers, their net charge-offs and their delinquencies are not rising fast. The only canary right now is subprime auto loans. They are. And they are underwater. People bought really expensive cars in 20 and 21 and they can't afford it and they've had high rates. So yeah, you can find a reason to be nervous. But I'm telling you, there's a lot of things to like about this market, and I'm telling you, the momentum's here, the earnings growth is here, and AI is transformative, and this is not a bubble. So I am totally out of time, but did we have any questions? I'm sorry, I didn't quite catch that.
Timing of the November 13th shutdown. What do you think is happening and driving that?
Well, it's very hard to comment. People are starting to get their notices, right? So part of this is a lot about the Affordable Care Act. People are getting their notices of health insurance. And so as this is dragged on, this whole, it's not a boogeyman anymore. Everybody's aware how much they may pay next year without subsidies. So one, that's going to put some pressure on the Republicans, because this isn't just about illegal immigrants getting health care or any of those talking points. It's going to be your everyday person who's going to get their renewal notices. Also, it gets it resolved before the third missed paycheck on the 15th. And so the likelihood, one, you've got bad timing with Trump out of the country, and Republicans are very hesitant to negotiate without him. But there will become some point, it's very difficult to argue that this is a necessary compromise, or else you are seeing true people get their premium notices of what next year is going to look like, and they are getting sticker shock. So it is a little bit of who has the most will, and obviously the SNAP and WIC is a big talking point right now, and again, that's miserable and tragic and very, very unfortunate, and my heart breaks for anybody affected by that. But again, that is a way to put pressure on getting it solved, but quite frankly, neither party wants to be the party that starved kids, and they shouldn't.
Thank you so much, Victoria. That was incredible. We really appreciate you.